Good afternoon. Welcome to our webinar. We're just sort of right on 4 o'clock now. We'll just give us a few more seconds, maybe half a minute, just to see if any more registrations come in right now, and then we'll kick it off very shortly. Hope you all had a good day today. Beautiful and sunny in Dunedin down here today. Gorgeous weather. We will try and kick this along so we can get out and enjoy a bit of the afternoon for the day. Yeah. All right, Shana, have you got some bits there to work through?
Yes, all right, so yes, welcome to the webinar. Thank you for coming along again. And if you're watching from our YouTube channel, thank you very much for joining us. And you know, if you enjoy this video, please check out the other videos that we have available as well. So as we said, this is our 3 essential tools for business success webinar, which is actually a really, really handy webinar, no matter where you are in business, whether you're learning the stuff or whether you're you know the stuff and you just need a reminder. It's a great webinar to watch. Here we are. So I'm the moderator today. So my name is Shana. So I'll be making sure that everything runs smoothly in the background, making sure the webinar carries on as it's meant to. If you have any questions throughout the webinar, I will be collecting them for at the end. So if you haven't used Zoom before, which I'm sure most people have by now, down the bottom, along the bottom there is your banner of stuff that you can do. So if you've got any questions through the webinar, hit that Q&A button and just fire through your questions as we go. Otherwise, you might forget by the end. So fire them through, and at the end of the webinar, we'll come back to them all and we'll work through them all that hasn't been answered already. If you have any problems with your speaker or anything, hit that audio settings, and down in the bottom right is the leave meeting for the end of the meeting there. So today's panelist is Greg Verhoef from Greg Verhoef Chartered Accountant. He's the primary here, the boss man, and he's going to be running our webinar today. So thank you, Greg. I will hand over to you now.
Lovely. Thank you for that introduction, Shana. And yeah, as Shana mentioned, this is a great webinar. It's got some really nice slides in it and some good points for anyone in business, really. So thought of the day, and this comes from The Rock, and the quote is like this. There is no magic bullet for business success. It takes hard work. However, using the tools at your disposal can drive hugely rewarding improvements. It's not about making drastic changes. It's about making small, incremental changes, changing old habits that get a little better each day. All right, and that was from The Rock, Dwayne Johnson, and I think a very fitting quote for today's presentation. Right, the agenda, what we're going to cover off today. So the power of 1%, which is about how small incremental changes add up over time. Having the courage to change, or what makes us go through changes. We then look at the three essential tools that help a business to plan ahead and make some changes, and then with some next steps, and then any questions at the end if we have. So yeah, if you have any questions, just fire them through. More than happy to stay online and answer any questions I see at the end of this. Just before I go any further, my usual disclaimer applies. The information in this webinar is of general educational nature, and if you need to make some decisions, please get some tailored financial advice specific to your circumstances. All right, we'll flick off into the next slide, which is the power of 1%. Okay, so hopefully you can see that nice graphic in front of you there, if everything's working the way it should be. So the idea of the power of 1% is that when we make small changes, those small changes made on a regular basis add up to quite a big change over time. So in this example here, this graph is meant to represent 1 year. And if we increase something by 1% change every day, then by the time we get to the end of the year, we would have a 37.8 times better off improvement. All right, so it's the effect of that compounding improvement that grows so big. So, so it's just sort of the idea of that you don't need to make big changes. We just need to make some small changes, but if we keep working on improvement, every day, every week, just a small improvement, all those improvements add up. Now, look, it's probably unlikely you're going to get a 1% improvement every day, but even a 1% improvement each week will double your output in 16 months. So that's still a pretty good change. Notice what happens if you don't make those changes. Let's say we just keep doing the same thing day in, day out. Then what you find is out there in the business world is your competitors are improving and they are finding new products, services, doing things a bit better, a bit more efficient, slimming their margin, their overhead costs, increasing their margins, training their staff, getting better productivity, all those things. So if you don't keep up with the changes, then gradually you end up slipping behind. So that's sort of like the red area of this graph that we're looking at down the bottom here. And that if we don't make those changes, then you are slipping behind everyone else by maybe 1%. And that 1% decline, of course, adds up to quite a bit over a period of time. So just an example here, your daily sales are, say, currently $1,000, and your sales regress by 1% every day, then by the end of the year, that $1,000 worth of daily sales turns into $30 a day. So it has that compounding effect the other way. It was Albert Einstein who came up with the phrase, compounding is the greatest mathematical discovery of all time. And that's that idea that every time you make a change, that by getting the gain on the change each time, the gains become bigger over time. All right. So change. I mean, we've all sort of probably read books about change. Change is all around us all the time. It's part of everyday life. We've had huge technology changes in the last 20 years. We have change in our business environment every week. We have change in our family, our friends, and everything else around all the time. So it's nothing to be scared of. And we just need to have a method of looking at change and deciding what to adopt and what not. So change is inevitable. Growth is optional. That's a John C. Maxwell quote. Now, we've got a couple of examples. So this example is Kodak. Now, Kodak was, the world leader, and back in 1976, it held an 85% market share on film and photography in that industry. Kodak was actually the person that first developed the digital camera. So they had the digital camera in the box, ready to go, and the directors decided that they were worried that the effect that would have on their film sales, they launched their digital camera. So while they had the technology, they didn't want to use it. They kept it back, and in the meantime, other competitors come along and overtook them. And we had digital cameras coming out. We had advanced digital cameras. Every year it would go from, first ones were like 1 megapixel, and then we had 1.2 megapixels, and then 3 megapixels, and then 5. And now we have phones. Our Samsung phone here that does like a 15 megapixel camera, and it's in my pocket all the time, and I don't use an ordinary camera anymore. It's been completely replaced. And so Kodak had that opportunity to be a leader in that side. They chose not to, and now they are. I don't even know if they exist anymore, to be honest. Yeah. So that's a good example of what happens when you don't change. Another example here, Blockbuster was one of the biggest worldwide movie stores. They had over 9,000 stores throughout the world, a huge firm. We had them here in New Zealand. And they looked at going online and was slow to change. And Netflix actually started in the year 2000 with a DVD mail service. And the Netflix CEO approached Blockbuster to discuss how the two of them might work together. However, Blockbuster didn't want anything to do with Netflix and basically told them to get lost. In 2004, Blockbuster then set up its own DVD mail service. And when the CEO of Netflix mentioned that Blockbuster had thrown everything but the kitchen sink at Netflix in order to compete with them, the Blockbuster CEO actually sent a kitchen sink to Netflix. So a bit of rivalry going on there. But Netflix, got out into the online market, move on from the DVD mail order service, and Blockbuster had all its franchises that owned all their stores, didn't want to go down that track. They were too worried about their stores being closed down and losing sales that they resisted that change, which of course now we know has resulted in Blockbuster virtually what is gone. And Netflix, I think one of the biggest online content services in the world, says here over 150 million users. So that's a huge amount. God, if they're all paying $15 a month, you can just multiply that out. $1 billion or something dollars a month, that's a huge turnover. So yeah. Right, having the courage to change. Oh, slides are not playing the game. There we go. So confusing looking formula there, but we'll break it down. It's more the idea of the principle of change. So on our right hand side we have R, and R is our, we don't want to change, our resistance to change, and we will overcome that resistance when the formula on the left hand side of the screen is greater than R. So when the when something is greater, of course the resistance gives way and we actually make those changes. So in this formula here we have, so D stands for dissatisfaction with the status quo. So when doing things the way they are is not working out, and it's not the way we want to go. V is our vision, which could be the positive of the future change or how things could be in the future. So when we multiply the dissatisfaction times the vision, we need to get a great big number. And then in order to overcome that resistance, it's not just enough to be dissatisfied and have a vision. We also need to put some steps in place to make those changes. So the first steps of the direction. So providing our dissatisfaction times our vision, and then we put in place some steps to make some change. Hopefully we'll overcome that resistance and actually make some changes. All right, we'll move on to the 3 essential tools. 3 essential tools, these are things that we tend to deal with most of the time here, and something we love working with our clients about. So our first one there is the annual business plan. So, you've probably all heard of business plans before. It doesn't need to be overly complex, but it needs to be a plan as to where your business is going and what you're going to do with it in the next year. An annual forecast is the numbers, it's our budget, it's the the sales, the cost of sales, there's overheads. It's a forecast as to what's our capital expenditure going to be, what debt we're going to repay or borrow. It's the numbers side of our business plan. And then the third most essential tool in there is the ongoing reporting with accountability. And that accountability, I think, is really the key to the whole thing. We've all done business plans and set them out, and they've sat in drawers and nothing's happened about it. We've done forecasts and set them to clients and nothing's happened about it. And I think the real key is that you have someone like ourselves or someone else independent of your business who's going to come and see you every 2 months, every month, every 3 months on a regular basis, and just sit down, pull out that business plan and look at how things are tracking against that. So that accountability, it's like going to the gym. We've all signed up for gym memberships. You go half a dozen times, you start getting sick of it and you give up. But if you engage a personal trainer and you're paying $50, $60 to meet with a guy or girl every, for 20 minutes every week, it's like, geez, I better actually turn up because otherwise I'm first of all wasting my money. And most importantly, they're going to be really pissed off that I didn't turn up to the gym. So that accountability keeps you going back to the gym, and the same with your plan for your business. You need that accountability. Make sure you put in place those plans. Right, so a business plan. What are there? All right. So business plan, like I say, it doesn't need to be 20 pages long, take 6 months to prepare, and and hopefully it's not COVID, and, and just a dry throat, and sorry, and yeah, it doesn't need to be something to procrastinate about forever. Right, so we've got these sort of 7 key points of a business plan, and first of all, a clear purpose. And we're talking 5 or 7 words, not great big lengthy purposes, 5 or 7 word statement that explains your business. An articulated vision, and by vision we mean what it's going to look like in the future. What is your business going to look like in 12 months, 2 years, or 5 years, whatever the business plan is looking at. What it is that you want to achieve. And that's really important. Different people have different goals in their life, and it comes back to their personal goals as to what's going to drive you to make your business do well. So if you want to work less in your business, then that's the goal that you want to achieve. If you want to make more money out of your business, if you want to set it up for sale, to sell to someone else, whatever the goal is, that's a really important part of your business plan, because that's what gets buy-in from owners. And what's also gets buy-in from your team ultimately. A high-level budget. So we're not talking the whole detailed thing here. This is high-level target sales for the year, target profit for the year, just those couple of key points. Relevant KPIs, and we're not talking about hundreds of KPIs, or even dozens. Just those key things in your business you need to get right. And what are the KPIs that we can quickly pull out of data sets, that we can pull out of databases to see if you're hitting those targets. So number of customers in the door, number of sales for the month, average dollar sale for the month, wage cost as a percentage of sales, food cost as a percentage of sales. Just those real sort of key KPIs that you're going to need to just keep your eye on the ball, see that things are heading in the right direction. Opportunities and vulnerabilities. So, what opportunities are out there for the business? What are the things that the business can pursue? Where is their chances to make gains, to do better, to improve, to reduce costs, to make more sales? All those sort of, what are the key opportunities and the vulnerabilities? What is the things to watch out for? What could come along and knock you off course? What could come out left centre and knock you over? So just being aware of those risks and identifying some of those vulnerabilities, so you're aware of them, so you can manage those things and be ready for them if they were to happen. Cascading goals and actions. So clear, concise goals for the year, measurable, achievable, and they should cascade over about a 90-day period for each action. It's important to review your business plan regularly and complete it on a regular cycle. Okay. Dry throat. Some guidelines for how to develop a business plan. Have the decision makers involved, the business owners, the directors, the key management of the business. I also think it's quite good to have some outside involvement. So maybe you've got a colleague in business who has good business experience, maybe they're from a different industry, but they're good value to have around the table when working on that business plan. Business coach, mentor, someone else you trust, family member who's in business, someone else who just can give you out some extra ideas outside the box. We have some pre-work. When we're preparing a business plan workshop for someone, each attendee has some pre-work to do, and some of it might vary depending on their skill set as to what they're doing, but it's about doing a bit of pre-work, so when we come together for a business planning day, we've got some core things to work with already down on the board. Independent facilitator, absolutely key that you've got someone who can guide the meeting, keep it on track, keep the focus on getting that business plan. It's real easy when you're in a room of 6 or 8 people to get off track, and all of a sudden you're developing the next solution to a problem that you don't actually have yet, or solving the world's issues. A facilitator who is going to drive the meeting, keep everyone on track, and also help prepare the final document out the other end. We reckon it should be a 1-page, well, probably 2 pages, double-sided bit of paper, so that it is simple, easy to read, something you can have on the pin to the wall next to your office desk, or stick it somewhere where you see it regularly so that you can easily review as to where you are and what you're up to. Share it with the team. Maybe you cut out some of the key figures, maybe you cut out some of the controversial stuff out of it, but the idea is to get your team engaged, your staff. You want them on board. If everyone's working together, got a common vision and goal, then it's a whole lot easier and things happen really well. Report monthly. So you want to be looking at your numbers and your KPIs at least monthly and reporting them against your targets to see if you're getting there. Probably once every 4 months, 3 or 4 months, you might want to review the goals and actions and just say, are these still relevant? Maybe some of the goals are no longer viable. Maybe some of the tasks that we're down there to do, are just not going to work now. Hey, let's just scrub them off the list and replace them with something that is. And maybe some things have been achieved and we can put the tick on and go, hey, we've done that. Now we're just going to wait for the results to come from that action. And it should be an annual cycle. Once a year, review the whole process and reset the business plan for the year ahead, celebrate the wins, and set your goals and visions for the year ahead. I think we have an example. Right, hope this shows up all right, but this is the template that we work to. So up on our top left there, see my mouse? No, you can't see my mouse, not over there. Up on the top left, I've got too many screens open. The top left there is our purpose. Purpose, top left. Opposite side of that is our vision. What we want our business to be in that next 12 months. We then have our what we want to achieve. So we've got some stats in there, some numbers, profitability, hours per week, and our values, our business values, how we want to operate our business, and some of our core internal values. We actually can do a whole workshop just on helping you extract your business values as well. And that's quite a good one too, I think. Because if you understand your values very strongly, it makes decision making as to what's right and wrong things for your business to be doing that bit easier. It doesn't fit the values, it does, right, let's do it. It doesn't fit their values, let's push it aside and move on to things that do. Okay, high level budget. So revenue, profit, gross profit, overheads, net profit, divided into quarters. Okay, so that when we come back for our quarterly reviews, we can see whether we've met those targets. So high level numbers, that's not all the detail. Bottom left here, key performance indicators. So the stuff that's easy to track and that we can have a look at. Very good. So in this case, we've got weekly sales, profit margins, labour utilisation, average revenue per client. Some nice, easy KPIs. We've identified our ideal client and our value proposition. So what it is that we provide for our clients. On the other side of the page, no, this is still our first page. Opportunities. Where we can make gains, our vulnerabilities we need to manage, and our most critical challenge. Other side of the page, we've got our 1 year goals, what we want to achieve within the 1 year. We've broken that down into some 90-day goals, and then what actions we need to do to achieve those 90-day goals. Who's going to do them, and a date that's going to happen by. So we've then broken that down into the rest of our goals, and the 90-day plan, the actions, and who's going to do it. Real important to have accountability as to who's going to do it, whose butt gets kicked if it's not done, and who do we hang if they completely stuff it up? No, we don't do that, of course. No. But anyway, that's a simple template of the business plan that we use, and I find it works quite well. Right, tool number 2 of our 3 tools is our annual forecast. And you might have done a forecast before because the bank asked for one. You might want to borrow some money, and they've come along and said, hey, we want a forecast. And then you did one and never looked at it again. But that's not really the idea of a forecast. The idea of a forecast is to project ahead what you think is going to happen for that year, but also to report against it, see what's working, what's not, where the numbers are and not working. And it also means that when you come to the forecast the second year, you've got some really good numbers to work with and some expectations that are more going to refined as to what could actually happen. So we talk about three-way forecasts, and it's really just there is effectively 3 different key forecasts. Don't necessarily always have to do all 3. Maybe you'll do 1 or maybe 2 of them, and it's just you can do all 3. But again, there's time involved with these things, and depends on what it is you're trying to achieve. That either the cash flow or the P&L might be enough. Pardon me, or a P&L and a capital expenditure budget rather than a whole balance sheet. So there's a bit of flexibility in there. So just sort of breaking these down, a profit and loss is, as it says, is the forecast of profit and loss. So income from sales, less expenditure in making those sales, less overheads to run the business, depreciation on the assets, interest on finance, and at the bottom is the profit. The idea is it represents how much the value, how you generated a profit for the business, how much better off the business is over a period of time. It doesn't include things like debt repayment, asset purchases, finance repayments, GST, income tax, or might include income tax, or those sorts of things, because they're not really part of our profit and loss. But if we were to do a cash flow statement, cash flow covers everything, and it's based on when the cash actually moves through the bank account. Whereas our profit and loss is actually based on sales, is based on the time you make the sale, which would be of issuing the invoice, and expenses are when you have committed to an expense, so when you place the order or receive an invoice. Whereas cash flow is when does the money go through the bank? So your sales income might come a month after the sale because you might be sending invoices and your customer takes a month to pay you. And the same with your purchases. But also your cash flow, in your cash flow, you also pick up things like debt repayment, finance repayments, asset purchases, payments to owners, all those other cash movements which are not part of our P&L. And the last one there is a balance sheet. Balance sheet is the at a certain point in time, so as of a day, and normally it's the end of the month, end of the financial year, end of the quarter, whatever that day is. It's a list of all the assets and all the liabilities at that period of time. And then over time, if we're doing a forecast, those things change. So if we have a $100,000 mortgage or $100,000 debt at the bank right now, at the end of the year, we might have hoped to have paid off 10,000 of that. So that liability will reduce. If we buy a new asset, that would add to our asset over that period of time. So our forecast of our balance sheet is just looking at the makeup of our assets and liabilities and how we're expecting them to change. Some rules to developing an annual forecast. Really, we like to encourage clients to do as much as you can yourself. You have a far better feel for your business and handle on what should be going on. And whereas we can make up numbers, often we find clients can get a better handle on those things. You tend to start with the sales and work your way down from there. Although in this example here, they say start with the end in mind. So work out your profit and work it backwards. So profit, add on the overheads, work out your GP, and that takes you back up to your sales that you need to achieve. So it can be done either way, or you start from the top down and then just adjust it till you get it to looking the way you want it. It's always good to compare it to last year, make sure it passes that sort of sniff test. Is it reasonable? Is it achievable? Or have you just gone completely haywire? And then just review it and adjust it as needed. Ongoing reporting. So this is the third leg of our 3 essentials tools. And as I think one of the most critical ones is that we have that accountability, that we're actually looking at what we've done, looking at the real-time results and going, did it work? What's working? What's not working? What do we need to do more of? What do we need to scrap? So things like Xero and databases and record keeping systems means we can actually get a lot of data out in real time now, and we can use that to do our actual numbers versus our forecast. And Xero has a quite nice, simple actual budget comparison that we use with a number of clients, and KPIs. So we should be pulling out those KPIs, reviewing them against our business plans to what we want to achieve, and sitting down every 2 months, 4 months, 3 months, and talking about why we achieved them, why we didn't achieve them, what's changed, what's right, what's wrong, and what do we change in our goals and plans for the next 90 days. Remember how we had each goal in our business plan, and we had the actions to achieve that, and then we had who was going to do it. And those are the things that we want to keep revising, just to keep that improvement. We talked about that 1% improvement, improve 1% every week. That's going to compound over the year. Accountability, independence is key. Having someone like ourselves who's got lots of business with experience with lots of different businesses, who can offer advice, who has connections and contacts with lots of other people in the business community, and able to use those skills to help with your business. The backbone, by being independent, if we see things that aren't right, or we don't feel good about some stuff, we're happy to bring it up and mention it, whereas someone who's part of the business is always got to, always thinking in the back of their mind, how does this affect me? So having that independence means you can call the shots as you see them. Document the actions. So we take this part of our role when we're doing our coaching sessions with our clients. We end up with a set of minutes as to what we talked about, and we end up with a set of outcomes of tasks that we're going to carry out for the next meeting. Consequences for inaction. Well, quite simply, if you don't do anything, nothing changes. And as we mentioned before, if you don't change, well, everyone else around you does, you end up falling behind. All right, we're almost there. So we can almost get out and enjoy a bit of that sun. Next steps, make a plan, do a business plan, engage with us to help with the business plan, create a forecast, get someone to help you be accountable. Focus on what you can do, not what you can't do. And this is what we do. We help our clients with their business. This is why we get up in the morning and come to work. We deal with lots of numbers and things like tax returns and stuff too. But this is the exciting stuff, and this is what we love doing is working with clients in their business. How can we help? So I mentioned we do a half-day business planning session. So that actually starts off with an initial sort of probably meeting, a scoping meeting as to what you need us to do. And then we issue some pre-work to those people who are going to be at the meeting. So there's a wee bit of time on our side to send that out and then collect that back. We will set up a half-day session. I like to do it off-site, pick a nice place somewhere where we can get a coffee and have a private meeting room and engage with the people who are there for the day. We have about a 4-hour workshop, has a whole heap of material that we can call on. Normally it'd be me there, but also I will bring someone else with me as well, who will be the coordinator and the minute taker for the day. And then at the end of our meeting, we'll try and, we end up with our 90-day plans and who's going to do what, and we'll take that away collect that up and issue you with your 90-day business plan and draft. You guys can have a look at it, make any tweaks and changes. We'll update those changes, and then we're off running for the year with our plan. So $1,500, it's a reasonable investment, a fair bit of time involved, but I think absolutely brilliant value for your business. Cash flow forecast, quite hard to price. We tend to start about $600, and it all just depends how complicated you want to make it and how detailed you want to make it, and how many times it goes back and forth. So we can sit down with you, do the initial figures, take that away, work that through into a forecast, and then send you a draft. And if you want to keep changing it, it depends how many times it goes back and forwards. There might be a bit more cost in there. At the end of the day, we charge for our time, but from about $600. That would be either for cash flow or a P&L. If you want to do the three-way forecast, you're probably looking at quite a bit more, I suppose, to get all three of those things together. And that's where I think maybe a profit and loss and capital expenditure list is as easy as anything. Coaching, accountability, depends on the frequency. If you wanted to have a meeting, say, every 4 months, then we'd set that up as $100 a month automatic payment, so it's $400 per meeting. But if you wanted to have them, more frequently than that, then the price is just adjustable to cover that. I have a number of clients we do that every 4 months. It's a good introduction. We've got some other clients we do it every 2 weeks. We get a lot more done. Every 2 months, we get a lot more achieved by meeting more often. Management reporting. So this is picking up the reports out of zero, giving them a good once over, asking you questions, making sure that they're right. Zero is easy to use, but it's still only as good as the operator. And getting all those things in the right places, and finance and loans and depreciation and all the extra bits working correctly as we were working that. So we $75 a month for doing that. Building better habits worksheet. So a nice little worksheet here. It just steps you through about how to make some better habits. Happy to email that out to you, no charge at all. And if you want to have a cup of coffee, give me a bell. Always up for a complimentary meeting. Have a chat about your business, what we do, how we work with our clients to achieve their goals, and what we can do for you. See if it's a good fit. At the end of the day, it's got to work well. If you don't think we're a good fit, that's fine. And we just want to work with clients who are happy to work with us on a good fit basis. All right, we're rounding up to about 40 minutes, which is nice. How are we going there, Sharma?
Oh, I think we're going pretty good. If you have any questions, fire them through, but we haven't had any questions come through yet. I can hear the sunshine calling everybody outside though, so
no, very
maybe
good.
we'll just round it up there.
Thank you. For all those who attended today, thanks for listening in. We hope you got some benefit out of it, and look forward to hearing from you. Parting thought: action is the foundation to all success. Pablo Picasso.
Pablo Picasso.
Picasso. Oh, was it
Picasso.
Oh, right. Okay.
Action is the foundational key to all success.
No, fantastic. Thank you very much for attending today. Look out for our future webinars. If you haven't been on to into our YouTube channel, we're posting these up there. There's probably half a dozen of these different webinars up there now. So yeah, jump on there, share them around. And,
like and subscribe, as they say.
Thank you very much.